So let's start with our second innings for the day. Before starting, I would request all the dignitaries, our chairman, secretary Gautam Latsar, speaker on the stage, please. Today we are privileged to have the presence of our young and dynamic chairman Ankit Rathi sir and also secretary CA Gautam Lat sir. So before starting the session, I would request Secretary WIRC CA Gautam Lat sir to give his insights to our session.
Thank you, Charmi. A very happy good afternoon, everyone. Okay, so I'm here to just brief about certain WRC activities, what we are doing, and make certain announcements and requests. So this year we started, since we are the closer of calendar year 24, we started in Feb 25th when we have taken the charge 25th Feb 24 as a chairman, under his able leadership, CA Ankit Bhai, and as a secretary of WIRC. The first event which we did is Women's Day celebration. I am sure a couple of you must have attended that at Kandivali. It was a mega big event with 750 female chartered accountants attending. We have also started an initiative to celebrate women achievers, CA women achievers. So it will be going forward, it will be a yearly thing. So we have celebrated 50 star women of WIRC over there. Then we did regional conference, massive regional conference at Geo. Then we did 101 team cricket tournament. We created a world record. A couple of activities which you should look for. One is WOFA. I'm sure you must have seen the standee outside. So how many of you have attended WACAU, World Congress of Accountants, which we hosted 2 years back? Only one. Okay, so it's a surprising. There were more than 10,000 plus attendees, and we can find only one from here. So we hosted WACAU, World Congress of Accountants, 2 years back. Last year we hosted GLOPAC. It's a global accountants event which we have started hosted. Uh, see. I personally believe that there are two things which is required to be a successful professional. If you want to succeed as a professional, one is content and the second is connect. I am sure everybody agrees to that. एक knowledge होना चाहिए and दूसरा you should have good connects to succeed. So both the things you'll find in those type of events, these type of events where we have best of the speakers. I would not say country, best of the worldwide speakers, and you have a 7,000, 8,000, 10,000 chartered accountants or CPAs attending those events and all other accountants globally attending these events. So it's a best chance to do networking. So whoever has not attended WACAU, I request everyone to please be part of WOFA. It's at New Delhi on 31st of January, starting from 31st January, Yasho Bhumi. It's a big event. We are expecting 10,000 plus accountants will join. It's a 3 days event. I am sure you will like it, and it will be greatly beneficial to your professional life. That's what we believe. So that's it from my side. One thing which about WIRC I would like to highlight, that this year we have also started more and more engagement with regulator. So what we have started doing, we have started training to department officials, to government officials, to regulators. So in this very own building, in this auditorium where we are sitting, I am very proud to tell you that we have trained more than 1,500 plus regulators over here, be it ED, SEBI, SFIO, Maharashtra Police, ATS, income tax, GST on some different subject. We invite them, we train them, we tell them what is ICI, what chartered accountants are doing, so they'll have a different perspective about CA, they'll have a respect about chartered accountancy. This is what we have started this year. So if you have anything, any of you would like to train, provide any type of training, or if you know any government organization when we can, as a ICI we can come together as a knowledge partner, we would be definitely to help them. So this is about WIRC initiatives. So thank you, have a happy learning. Thank you so much.
Thank you, sir, for giving a marathon of all the activities done by WIRC and also tentative programs. It's now I request CA Ankit Rathi, sir, chairman of WIRC, to give his insights. Over to you, sir.
Very good afternoon. It's absolute pleasure to be here with you all. At the outset, let me first thanks to our today faculty, Santosh Maller sir. Sir, thank you so much. Despite of your so much busy schedule, you accept our invitation and agree to share your valuable knowledge with our participants and bless our dice, sir. Let me also thanks to our coordinator, Charmi. Thank you, Charmi, for your entire service to the fraternity. Friends, let me also recognize and thanks to Secretary Gautam Lat for highlighting all the activity of our West India Regional Council and designing this two-day program on IND AS in very well manner, so our participants can take maximum benefit out of them. Friends, I just wish to request you about two or three things which I really think very important. As everyone is talking about the developed India by 2047, when we celebrate 100 year of our independence, the economy is going from 4 trillion to 40 trillion. Friends, let me share you, if I can ask or I update you about the number of chartered accountant in India is around also 4 lakh or 4.2 lakhs, and our economy is also 4 trillion. The government, Honorable Prime Minister Narendra Modi is very sure about 4 trillion to the journey of 4 to 40 trillion in this Amrit Kal, in next 25 years. But we are not very much certain or sure whether we become 4 lakh to 40 lakh. The kind of opportunity we as a chartered accountant carrying is immense, I can say. Let me share you one of the example of 2 day back. 2 दिन पहले सर कुछ सेबी के ऑफिसर्स बॉस अपनी बिल्डिंग में थे, हम लोग जनरल डिस्कस कर रहे थे, तो एक ऑफिसर मेरे को बोलता है कि यार, चार्टेड अकाउंटेंट थे वो, मेरे को बोलता है कि यार अंकित भाई, हम लोग बैठे रहते हैं, डिस्कस कर रहे होते हैं, और हमारी चेयरपर्सन बाजू वाली डेस्क पे अगर किसी से कुछ डाउट पूछ रही होती है ना, तो सडनली उनको कुछ डाउट आता है तो उसे पॉइंट आउट करती है कि उसको पूछ ले, वो सीए है. That kind of reputation we all carry because of the two words, the chartered accountant. My humble request to each one of you, we at the ICI level and even the region, branches, study circle level are doing really very hard for the career counseling at the university, school, colleges. Even yesterday we was with our honorable governor, because he is the vice chancellor of all the universities. We discussed, sir, how we can more promote our CS as a best profession over the university and college. My humble request to you as a chartered accountant, actually we really need a career counseling in our house, in our offices, in our dinner table, or in our societies, so we can updates our fellow commerce graduate students or even a school students के what kind of opportunity और what kind of reputation we as a chartered accountant करेंगे. अगर मैं फ्रेंड्स आप लोगों को पूछता हूँ कि यार एवरेज पैकेज एमबीए का या इंजीनियरिंग का कितना है, तो हार्डली हम लोग बता पाएंगे, और जॉब सिक्योरिटी कितनी है. पर अगर मैं सीए की बात करूँ, व्हेन आई वाज क्वालिफाइड इन 2014, द एवरेज पैकेज अराउंड 5 लाख और 5.5 लाख, एंड कैंपस में हम लोग जाते थे तो डर लगता था कि यार हार्डली 40 से 45% लोगों को कैंपस मिलता था, और इवन बिफोर 2014 मेरे हिसाब से 20% था. बट आई एम प्राउडली से कि पिछले कैंपस में वी हायर्ड और कंपनीज हायर्ड मोर देन 95% newly qualified or fresh qualified chartered accountant with the average package of more than 12.5 lakh. So that is the average package which industry offer to our chartered accountant members. So we need more and more career counseling. My humble request to each one of you, please do update about this, the reputation, the opportunity about CA course to the new students or new generations. Another request, we at our West India Regional Council, friends, we need more and more coordinator, contributor, even a speaker. If you wish to become a participant like as a coordinator, or you wish to participate as a speaker, or if you wish to write any article in our newsletter, or you wish to write any book or publication, or you wish to participate in research paper, please do write my role at the rate WIRC. In our Western India Regional Council website, there is a tab called my role at the rate WIRC. You can write, or if you think we as a regional council or we as a ICI need to do particular things in a way in which we can contribute to our fraternity or in a nations, please do write. We are happy to assist, or we are happy to help. With this, I will not take your much time because we are all here to listen Santosh ji. I wish you all happy learning. Thank you so much.
Thank you, sir, for your insights. Now let us begin our next session on discussion around common errors identified by regulatory body under IND AS financial statement by CS Santosh Maller, sir. Before starting the session, let me take a moment to formally introduce him. He has passed his CA exam with an All India merit rank and worked for a large audit firm EY and Deloitte in IFRS technical desk for more than a decade. He has 20 years of professional experience in accounting, advisory service, and audit assurance, including large audit firms. He has authored several books on financial reporting and serves as a visiting faculty in GLC College, Mumbai, speaking on accounting standards and corporate governance. He has been serving as a special invitee in ICI ASB board, ICI Expert Accounting Committee, and has been part of several technical study group of ICI. With this brief introduction, I welcome you, sir, and also request our chairman and secretary, sir, to give him a memento. The stage is all yours, sir. Thank you.
Good afternoon, everyone, and thank you for the kind introduction and to kind of set the context for the rest of the day. I have two sessions today with you all, so you all have to bear me for a couple of sessions. One of the speakers, unfortunately, there was a family emergency, and I had to the last session for the day will be also taken by me. The first session, friends, will look into, as the slide suggests, we'll talk about the practical implementation issues while applying IND AS 116 leases. For most of us would know, but leases. So this lease accounting standard, as we know, since last few years, in fact, last 3-4 years. There has been a massive change in the way we account for leases, especially from the perspective of a lessee under IND AS. As per the accounting standards, AS 19. So again, in India, we have seen the entire transition, right? So when I was doing my CA, right, I was a CA student. There was no standards, so there were no, of course, IND AS. This is about 22 years back. There was no IND AS standards. Okay, the new thing was accounting standards, and it was until AS 16, borrowing cost, and there was no standard on leases back then. And there was this institute's guidance note which talked about how to account for leases. And if you see the risks and rewards in a leasing arrangement being passed to the to the lessee, then to the lessor, then in that case there was a finance lease kind of an accounting. But it was not compulsory, it was a guidance note, right? It was back then, it was a institute's guidance note, not a binding on the companies, binding on the practitioners, as we all know. Then came AS 19, and there were a lot of discussions on AS 19, institute seminars, webinars, etc. Of course, it was seminars back then. This entire thing about finance lease accounting, how do you get, if you're not owning the asset, how do you account for the asset in your books? How do you, what is the nature of the liability that you set up as a finance lease obligation, etc. There was a huge, disturbance or huge debate or discussions in the accounting in the CA fraternity. And of course, the tax implications, the indirect tax implications, so on and so forth. And maybe it took 4-5 years for lease, AS 19 to settle down, and then, people were kind of overall comfortable with the concept of finance lease accounting. And then when as a country we adopted or we converged to IFRS, IND AS brought some very new concepts within the leasing landscape. There was this concept of IFRIC 4, or this one of the appendices to AS or to IND AS 17. That so when we transitioned to IND AS, there was no IND AS 116, right? So when we adopted IND AS 17, which was pretty much similar to AS 19, except for the fact that there was this definition, the scope of leasing arrangement was much broader. So even if there is no lease agreement on paper, right? So under AS 19, we used to account for as a lease agreement only if there is a lease agreement, right? Otherwise, there is no leasing. So there's the concept of determining whether an arrangement can be accounted for as a lease. So in substance, whether an arrangement is conducted in such a way that it automatically partakes the nature of a lease. That concept was introduced in IND AS 17. And later on, after a few years, we transitioned to IND AS 116. So friends, now there is, from the lessee's point of view, there is no concept of operating lease. It is entirely a concept of a right of use and lease liability. So as a lessee, so whereas the lessor still distinguishes between an operating lease and a finance lease. So as a lessor, I need to still look into the criteria, the 5 indicators, whether it's a finance lease or an operating lease. But from the lessee's point of view, with certain exceptions, it's entirely a game. So there's no concept of finance lease or operating lease. It's entirely a right of use asset or and a lease liability, with certain exceptions for short-term leases and for low-value leases. So over a period of last 2 decades, the leasing, accounting for a lease transaction has come a full circle, right? Right from the point of not having a standard dealing with leases, now we have a lot of literature, a lot of guidance, a very, I would say, a fairly complex, a very robust standard on lease accounting under IND AS. So the idea, the way I have gone about designing the structure of this session is that we will have a quick look at the IND AS 116 requirements. Okay, I'm sure most of you would be fairly familiar with this, but maybe we'll spend 5-10 minutes on refreshing what is, ROU asset, lease liability, so on and so forth, lease term, options, etc. And then we will take about 15 to 16 case studies that I have selected based on, what I felt was practically a bit of a tricky issues. And needless to say, please feel free to ask your questions during the course of this session. It's good to keep the session interactive. So with that, let's start the session. So earlier in IND AS 116, earlier in IND AS 17, there were 2 concepts, finance lease and operating lease. And in case of operating lease, it was a executory contract, right? From both the lessor's perspective and the lessee's perspective, there was no balance sheet accounting for operating leases. Okay, finance lease, of course, based on the risk and rewards model, there was this accounting in the books of the lessee as an asset and a liability. IND AS 116, entirely everything is leases. Okay, from a lessee's point of view, of course, from the perspective of lessor, the distinction between operating lease and finance lease continues. The initial recognition and measurement. So as a lessee, the accounting is right of use asset and lease liability, right? So there's no concept of whether it's long-term, short-term, whether it's significantly, transferring the risks and rewards. OSUB, there is no, considerations for that. The moment you have a long-term lease arrangement, you automatically create an asset in your books and a corresponding liability. Basically, the genesis again of this was a few years back when the chairman of the ISB, was traveling from New York to London, and he discovered that the flight, the aircraft on which he was traveling, was not in fact in the books, in the balance sheet of the aviation, the airline, the company which was actually running the airlines. And that made him wonder that, is it, proper accounting? So because of that incidents, he embarked on this project that all the assets, all the leasing arrangement, if a major asset like an airline is not on an aircraft is not in the balance sheet of the airline company, then we as accountants or as accounting standard, setting board, are we doing the right thing? So that, he took it very seriously. He started this project on lease, and after I think it took about 12 to 13 years for the project to fructify into a standard. And again, this was a joint project between the ISB and the FASB, right? So there were a lot of deliberations. Obviously, it was a shift of the entire mindset, right? Right of use asset. So the conceptual framework for this is, when I'm leasing an asset for a duration of time, and against that I'm paying the lessor certain consideration, I have a right to use that asset for a particular period of time, and therefore there is a asset. The asset is not actually the physical asset, that the ownership of that asset, but the right itself is an asset. And uske badle, correspondingly, I also have an obligation towards the lessor of making him payments, specified payments in a specified term. So that is a liability. So the entire thinking is that the asset, the physical asset, is not the actual asset which I need to account for. It's the right to use that asset that I'm accounting for. We know that in Schedule 3 there is a prescribed format for the balance sheet. So ROU asset is captured in a separate line item on the face of the balance sheet as per the format that Schedule 3 sets in all the both Division 2 as well as Division 3 of Schedule 3. Subsequent measurement, ROU asset is depreciated based on the current depreciation policy. It may be WDV, it may be SLM, but if the leased asset is there in the lessee's books, and if you have a similar class of assets on an ownership basis, which you would have classified as property, plant and equipment, the depreciation policy that you would have otherwise adopted for the fixed asset or the PPE would have to be also applied to the ROU that you have now within the same class of assets. Likewise, in case of lease liability, now how do you set this? You set this up based on the present value of the lease obligation, the minimum lease obligation that you have over the lease term. You discount it at the incremental borrowing rate. So obviously, as you go ahead, there will be an unwinding. So you would have a notional interest cost, and you would have a notional depreciation cost. So to say, notional, right? In case of, so in P&L, you would not have any lease cost or rental cost. You would only have a depreciation and an interest cost. So over a period of time, the total impact on P&L is the same on a cumulative basis, but year on year there would be difference, and because obviously you are doing a discounting, there would be initially a higher, the sum total of the depreciation and the interest that you would have in your P&L in the initial year will be higher than had you not done this accounting. Had you kept it simple, you would have just accounted for the accrual of the rental cost over the period, right? So initially it will be like a front loading of your P&L hit, but over a period of time, obviously cumulatively it has to be same, because that's how arithmetically it would work, right? So the other thing about this is, in terms of the optically, from an EBITDA point of view, this augurs well for the company. So if you see, when IND AS 116 was applied, a lot of retail companies, a lot of companies into logistics, so example Shopper Stop, or some of these companies like Mahindra Logistics, they in fact had to go in their corporate presentations stating that impact on EBITDA because of IND AS 116 application, right? Because the moment you have a reduction in your rental cost, and you have a notional interest cost and a notional depreciation cost, your EBITDA automatically improves, right? And therefore, you need to explain to the users that there is this standard, there's nothing has changed fundamentally in the business, but this accounting standard has changed, by which I don't account for my rental cost as an operating cost, but now it is interest and a depreciation in my P&L. So there has to be a communication to the users at large. As I said earlier, there are a couple of exemptions to this. So if it's a short-term lease, that is, if the tenure of the lease arrangement is less than 12 months, you don't have to worry about these complications. You keep it simple. You account for the rental cost on a accrual basis, right? Not worth doing all this exercise. The standard acknowledges that the cost-benefit analysis doesn't work. So you keep it simple. For short-term leases, you just account for it as a cost. Exemptions for leases with lease term of 12 months or less, this assessment to include periods covered by an option. So again, there is a kind of an anti-abuse provision in the standard which says that if आपका lease term ऐसा है, every 11 months you have an option to extend, then you need to take a look at the guidance of lease term under the standard and evaluate whether the extension option or the renewal option is also, it's probable that you will exercise it, and therefore consider it in determining the lease term. And basis that determination, if your conclusion is 3 years, then you need to account for it as per IND AS 116. If you feel that the option, the renewal option is not probable to be exercised, then yes, 11 months you can stick to this, and therefore you can take the short-term exemption of not accounting for as per this ROU and lease liability. The exemption is applicable for leases containing purchase options also. So for example, many lease agreements have a purchase option, especially a lot of equipment financing, equipment leasing arrangements where an NBFC or a bank comes in and gives an equipment to a company on a lease basis. End of the day, because NBFC or bank वो equipment का क्या करेगी, there's a purchase option, which is a very favorable option because at a very highly discounted price, the company can actually purchase it subsequently, and therefore in this evaluation of whether it's a short-term lease or a long-term lease, purchase option is also required to be evaluated, considered to determine the lease term. What is a lease term? Non-cancelable period. So if there is a cancelable lease, then that's not forming part of lease term. So there has to be a term that is ascribed in the lease agreement, or the contract which is getting into the mode of lease, which includes the period covered by the option to terminate the lease if only a lessor has a right to terminate the lease, right? So the right to terminate is considered only if it's at the option of the lessor in this definition of lease term. Coming to renewal options, the period that is covered by an option to extend the lease if the lease is reasonably expected to be exercised. So the entire judgment falls back on this reasonably expected, right? How do you evaluate this? Whether there's a historical precedence, पहले सालों में आपने क्या किया है, whether you have extended the lease, is there any incentive for you to extend the lease? So for example, later on the subsequent periods, if the lease rentals is reducing, then perhaps there is a there is a financial incentive to you to the lessee to extend the lease. So all those factors, or if it's a special purpose lease, right, a special purpose equipment. So the nature of the asset is such that only you can use it. So it's tailored for the lessee. In that case, again, you need to prolong it. You need to consider that there is a significant, it's fairly reasonable to expect the lease to be renewed. Lastly, the termination option. The periods covered by an option to terminate the lease if the lessee is reasonably certain not to exercise the option. Yeah. Yeah. Yes. No. So again, yeah, you're right. So it will be for the first 2 years for sure. For the remaining 2 years, you will have to examine whether there is a renewal option and who has the option. If it is the option, if the option vests with the lessor, which is often the case, then in that case you don't consider that. But if it is vesting with the lessee, supposing 2 साल के बाद जो beyond that further 3 years का जो है, yeah, if it's an annual thing, if the renewal option for the remaining 3 years is vesting with the lessee, then you need to consider whether it's reasonably expected to be exercised. So if it's option with the lessor, then you don't consider it. Why? Because it's not in your control. You're doing this accounting from a lessee's perspective now, right? So you don't consider that because lessor karega ya nahi, you don't know. So you cannot set up an asset and also a liability basis his expectation of his actions. But you can only develop a reasonable expectation for yourself as a lessee, and us case mein, if you have an option to prolong it beyond 2 years, you need to consider whether there will be some incentive, some probability that you will extend it beyond 2 years. But first 2 years, if it is a lock-in period, you need to set it up for the first 2 years for sure. Coming to what is reasonable certainty, as I said, there are various factors that needs to be considered. So for example, if it's a specialized assets or lack of alternative asset. So many a times these leasing arrangements are a bit like a financing arrangements. The asset is tailor-made for the lessee, right? So for example, if it's a specialized equipment that let's say a factory is using, it's on lease basis, and the equipment is such that only that company, the factory that is leasing it, can use it. It's tailor-made for that. Then obviously there's business compulsion that it will be renewed. So in that case, you would have a longer tenure of the lease term. Significant leasehold improvements. So again, a few years back, the EAC had got this query from one of the companies that there is a 9-year lease term, right, with options to be exercised at every 3 years, every third anniversary. So you have 3 plus 3 plus 3, and at the third anniversary, there is no compulsion to extend it to further 6 years or further 3 years. And both the lessee and lessor can actually wriggle out of the lease, which means that there's no binding to extend it beyond 3 years. But having said that, so that queries, the company which had raised it was in fact a salon, right? So one of these beauty salons who leases properties for 9 years, 3 plus 3 plus 3, and does a significant leasehold improvement in those outlets. Okay, so entire refurbishing to suit its branding, entire carpeting, ceiling, etc., everything, and there's a significant leasehold improvement. So the EAC in that case opined that no, because you have done a significant leasehold improvement, and because there is a precedence that you in the past has also have also renewed it for a longer time, in that case you need to consider a longer period of time. And also, by the way, the other part of the query was what should be the useful life of the leasehold improvement, because leasehold improvement is part of your property, plant and equipment, right? So the useful life of the leasehold improvement, the property, plant and equipment, cannot be longer than the lease term. So what you assess as a lease term is also important, not just from lease accounting perspective, but also from the perspective of depreciating the leasehold improvement that you have done, the interiors that you have done in the leased property. It cannot be beyond that. It can be shorter than the lease term, but it cannot be longer than the lease term. The other part is termination and relocation cost. So if you have to move from one place to another, so for example, if it's a corporate headquarters, right, which is on lease basis, in prime area of, let's say, South Bombay. And if it's a prestigious thing for, maybe a multinational bank or, one of the large corporates. And so obviously from the perspective of shifting the head office or a very strategic outlet of a company, it will be a nightmare, right? It will be logistically a very difficult decision. So that also is to be considered while determining the lease term. Favorable terms compared to markets, as I said, if it's a lopsided lease structure. So for example, in the first 3 years, the lease rentals are fixed and subsequently it's on a declining trend, right? So obviously the idea is to incentivize the lessee to extend it beyond the initial period, and therefore that has to be also considered in assessing the reasonable certainty for the lease term. Let's take an example. A Limited enters into a lease for a building that includes a non-cancelable period for 4 years and 2-year market priced renewal option. Before occupying the building, A performs leasehold improvements and interiors based on its requirements. Leasehold improvements are expected to have significant value at the end of 4 years, and the value can only be realized through continued occupancy of the leased property. At the commencement, A determines that it is reasonably certain to exercise the renewal option because it would suffer a significant economic loss if it is abandoned, if it abandoned the leasehold improvement at the end of the initial non-cancelable period. At the lease commencement date, A concludes that the lease term is 6 years. So because you have incurred a significant cost in the interiors, and because obviously if you have to move out after the 2-year period, there will be again a substantial cost. So again, that perspective, that aspect has to be considered in determining the lease term. Lease term reclassification, triggers of reclassification, significant change in circumstances, right? If, let's say, the lessee is shutting shop, okay, if it's a MNC company which is in India, but it's now decided to move out, to exit the Indian markets, then obviously even if you have a longer term lease and if you have an option that is renewable, then in that case you may say, okay, now pehle I had a, my assessment was different, now I'm not going to extend it beyond the, the renewal period. A significant event that is within the control of the lessee and affects the reasonable certain assessment on exercise of options. So examples: unanticipated significant leasehold improvement, unanticipated significant modification to or customization of underlying asset, inception of sublease with period beyond previous estimates, business decision of lessee directly relevant to exercise of the options. Coming to lease payment, again, so you have determined there is a lease, you have determined the lease term, now it is, it is coming to measurement now, right? So what is to be considered, what is not to be considered, right? So in this case, what is included in the lease payment? So lease payments are the amounts payable during the lease term by a lessee to a lessor for the right to use an underlying asset. That's the simple definition of lease payments. It includes fixed lease payments less any lease incentives receivable. So if there is any lease incentives, oftentimes the lessor incentivizes the lessee, so that has to be reduced. It's not an income, it's a reduction from the ROU or from the lease liability. Predetermined lease escalation, so if there is an annual escalation of 5%, that has to be considered in the lease payment. Variable lease payment based on an index or a rate, like a consumer price inflation, so in that case it has to be considered. So even if it's a variable thing in nature, but if it is based on an index, it is to be considered. So for example, if it's based on a retail price inflation, okay, sometimes in some of the cases you would see such terms in the lease agreement, in that case it has to be considered in the lease payment definition. An exercise price of purchase option that is reasonably certain to be exercised at the option. What is not included in lease payments? Variable lease payments not based on index or rate. So for example, if there is a revenue share, right, in many of these new malls, the mall owners, the lease term is such that apart from a smaller figure of fixed lease rental, there is also a percentage of revenue that the retailer has to pay to the mall owner. So that percentage of revenue is not to be considered for the purpose of ROU accounting or lease liability accounting. That is accounted for on a accrual basis, as is when is, right? Amount allocated towards non-lease components. So for example, if there is lease of an asset and there is an underlying service also which the lessor is offering to the lessee. So for example, if I have leased a coffee machine, let's say 40 coffee machines in my office from a particular company, and to service those machines, to fill the coffee beans and basically clean up the coffee machines, the lessor has also given me 4 or 5 people who would attend to it, maybe on a daily basis or a half-day basis. So that part is service part, right? The labor part is the service part. That is not a subject matter of lease accounting under IND AS 116. That is separately to be accounted for. What is to be accounted for is the fixed rental for the coffee machines that I have rented. Yeah, and finally, exercise price of a purchase option. I think there's a typo here, not is missing, so it is not reasonably certain to be exercised. Sorry about that. So we have determined the lease term, we have determined the lease payments, and now we come to discounting, right? What is to be discounted? What is the rate to be used for discounting? Incremental borrowing rate. The rate of interest that a lessee would have to pay to borrow over a similar term and with a similar security, the funds necessary to obtain an asset of a similar value to the right to use the asset in a similar economic environment. So it's a lessee specific rate. Many a times some people get confused whether it's the lessor's discounting rate, borrowing rate, or the lessee's. It is the lessee's because the lessee is being financed in this scenario, right? It's specific to the economic environment, currency and date of the leased asset. So as a reference, if you have to go to the borrowing should have been around the lease commencement date. If it's 2 years back, ekdam purana wala loan hai, you cannot use that as a reference rate for incremental borrowing cost of a lease which is entered into subsequently 2 years later, right? So it has to be around the same period. Couple of months here and there may not make such a big difference, but it cannot be a period of 1 year break or 2 years gap. For a period consistent with the terms of the lease agreement. Again, this is very, very difficult to get exactly the same term because lease term may be different. The reference loan that you are using to determine the borrowing cost may be different. It may be shorter, it may be longer, and you need to make adjustment for that. There is again no guidance exactly how much alpha, how much adjustment to make for the tenure difference, but that is again a matter of judgment and specific to the nature of the security. So the implicit, so if you are not having, so one thing, there are two things. As a preference, the standard requires you to discount it at the implicit rate of interest, right, in the lease. If it is not determined, and in 90% of the cases that I have seen, implicit rate of interest would not be, directly derived in the agreement, in the lease agreement itself. So you have to go back to the incremental borrowing rate. But if theoretically, if implicit interest is there, then basically the present value of the lease payment plus the present value of unguaranteed residual value equal to the fair value of the underlying asset plus initial direct cost. So the value, the rate at which the lease payments would be equal to the fair value of the asset plus the initial direct cost. That is how you can, on an Excel spreadsheet, you can plot and use that, IRR formula to derive this implicit rate of interest. But very rare to see. Generally, people fall back on the borrowing rates, incremental borrowing cost. Initial direct costs, the definition only covers incremental cost that would have been incurred if the lease would not have been obtained. Example, commission paid to a broker. So if you have paid to a real estate broker some commission or brokerage to get the lease agreement, so that is considered as an initial cost. Or let's say certain payments made to existing lessee. So those are forming part of initial direct cost. This is important. Why? Because initial direct cost is also, it's not immediately expensed. It is loaded in the ROU cost, right of use asset, right? So initial direct cost excludes any cost incurred regardless of whether the lease is entered into. For example, if you have an administrative team who has been, scouting for a leased premises, their cost cannot be capitalized as a part of initial direct cost. So all you can capitalize as initial direct cost is only the commission, the brokerage, the legal fees, the stamp duty, etc., which are incremental to the lease agreement. Means that had the lease agreement was not there, you would not have incurred the cost. Initial direct costs are included in the lessee's initial measurement of right of use asset. So you capitalize it as a part of ROU asset. So that was a bit of a basics, or kind of the fundamentals of lease accounting under IND AS 116. We'll take, as I said earlier, I will take through a few case studies to get into, to kind of deep dive into some of the practical aspects of this standard. Before that, any questions, any yeah. Yeah. You're talking about the leasehold improvements? Yeah. Useful life of what? The ROU asset? Okay. The interest rate you're talking about. The rentals, yeah, yeah. Yeah, so see, from the perspective of, so to answer your first question, yeah, so ROU as an asset, as I said, the asset is not the underlying asset itself, the actual physical asset. You're not owning the asset legally, right? What you have is a right to use that asset. You're right in saying that the depreciation requirement is it's depreciated over a period which is lower of the useful life or the lease term. Now, why this lower, right? So, for example, if let's say if you have leased an equipment and the lease term is 5 years, right? So the maximum depreciation life is 5 years that you can. But the equipment is such, as a requirement. Let's take an example where you as a business, you as an entity do not require it. So it's not useful. The economic life of the equipment has shortened for whatever reason, technological obsolescence or redundancy or whatever, then in that case you cannot keep it as an asset. You need to actually accelerate the depreciation in that case. The lease liability is a contractual liability. So irrespective of whether the asset is still economically useful to you as it was earlier, determined at the inception, lease liability that you have in your books is a contractual liability. You may accelerate the depreciation, but contractually you don't need to specifically pay off the lessor early, right? So you can still buy time. So whatever was agreed initially as per the agreement, you can still stick to that even if you're not using it. So for example, let's say a simple case where let's say आपने एक गाड़ी लिया है EMI पे, example, right? The loan agreement is for let's say 3-4 years, okay? And let's say after a couple of years, let's say you guys just got bored driving that car, you have upgraded to a bigger car or a different car. You are using it, कुछ वैसा हुआ नहीं है, maybe your family member, somebody else is using it within the family. But for you, it has you have moved on in life, and you don't necessarily need that car. But doesn't mean कि आपको बैंक को तो 4 साल में ही चुकाना है वो किस्त, right? So therefore, contractual liability will still continue. You don't need to accelerate that. Coming to your second question was basically escalation, right? So escalation, if every year, if there is a certain percentage of escalation, you account for it, because the way this standard conceptually goes is the entire lease term and the entire lease payments is your liability today. The moment you sign off on the lease agreement, you have stuck your neck to pay the payments that have been fixed in the agreement over the lease term. So uska fair value of discounted value nikalo aaj. So straight lining is not allowed now. So it has to be, in a sense, front loaded. So effectively, had you not done this accounting, wo 5% escalation, 2% escalation would have arisen when you would have accrued it. Next year it would have hit your P&L. But now you're front loading it, because the way this standard looks at the arrangement is that when you sign up for the lease agreement, you have actually undertaken an obligation to pay for the future payments also today itself, and that you need to present value and account for today itself, and that also is captured in the asset, on the asset side as a ROU asset. Yeah. So let's take a few questions, case studies. Let's start with this concept of determining whether the contract is within the scope of IND AS 116. Entity X, a private sector entity, enters into a contract with a transport ministry, the grantor of country S, to acquire the right to operate the civil air navigation system in country S. Under this contract, the grantor provides the air navigation system. X is required to upgrade the system. X will charge users based on the rates negotiated directly by it to individual users. There is no price cap mechanism imposed by the grantor, and the contract is for a period of 10 years. Question is it a IND AS 116 contract or is it outside the scope? Yes, please. On this screen? Acha, I did not realize कि वहाँ पे नहीं है. I'm not sure how to do that. So you can see one of these volume. हाँ, मिश्रा जी है वहाँ पे. अरे ये वहाँ पे स्क्रीन में नहीं आ रहा है, बाजू के टीवी में नहीं आ रहा है. Yeah, thanks for pointing it out. So anyone? Is it a lease contract under IND AS 116? Percy, what do you think? No? Why no? Okay. Yes. It's a aircraft thing, right? So yeah. Anybody else? It's a service. So your answer is yes or no? It's not? Yes? No? Okay. Paragraph 3 of IND AS 116 inter alia states as follows: an entity shall apply this standard to all leases, including leases of right of use assets in a sublease, except for service concession agreements which are in the scope of Appendix D service concession arrangements of IND AS 115. In the given case, the arrangement has many characteristics of a public to private service concession arrangement. Example, the grantor is a public sector body, the operator is a private sector body. The operator is responsible for the upgrade and operation of the service concession infrastructure, and infrastructure is used pursuant to public policy. However, under the terms of the contract, the grantor does not control prices. Therefore, the contract is not within the scope of Appendix D to IND AS 115, and the right of use the air navigation system would be within the scope of IND AS 116. The scope hierarchy of IND AS 116 is such that if the contract is falling within the scope of a service concession, which is the public to private concession, and there are certain conditions, criteria which need to be fulfilled in order for a contract to get into that. So typically your airport concession contracts, your road concession contracts. Here, because there is no, so there are two criteria within that everything should be determined by the grantor or agency appointed by a grantor, and the price should be determined by the grantor. In this case, the price is not determined by the grantor or the ministry, and therefore this falls within the scope of IND AS 116. Many a times the EAC gets such questions from many PSU companies that there is this agreement, arrangements, long-term arrangements for a railway corridor with Ministry of Railways or something. So typically the question is it a lease agreement or is it a service concession agreement? So in this specific case, it is within the scope of IND AS 116 because the scope criteria of IND AS 115 Appendix D have not been fulfilled. Let's go to the next question. The last mile of a dedicated cable that connects entity Y's network with end customer's device. The use of this cable is at the discretion of the customer. Entity Y decides the location of endpoints and has a right to replace the line's dedicated cable. However, it is not practical to replace the lines since the replacement would require significant additional cost to be incurred without any corresponding benefit. Question is whether the arrangement is within the scope of IND AS 116. And there is another scenario in the case study that if it is practical for entity Y to replace the lines and entity Y would benefit from the replacement, would the answer be different? अभी बताइए, अभी क्या लगता है आपको? 116 applicable है या? So this is typically a scenario of a let's say a set-top box kind of a scenario where you have taken a set-top box and there is a dedicated cable line. So your building may have a connectivity, and then there is an extension of the cable dedicated lines in your customers. It can also be in a way this Mahanagar gas arrangements where you have the gas supply and then they charge you some fees for the piping that comes to your kitchen, right? So in this case, the fact pattern says that the use of this cable is at the discretion of the customer, right? Of course, it will always be at the customer's discretion. There is no restriction to replace the dedicated cable line, but who will do that, right? People like us, we don't know the technicalities of changing the set-top box or the cable lines, and there is no benefit of doing that. So in that case, is it a lease agreement? Have I leased the dedicated cable from the telecom company or the set-top box from the telecom company, or is it a non-lease, as in is it a service agreement? Lease? Non-lease? Specifically? Okay. Okay, let's see the answer. So, paragraph 9 of 116 says that at the inception of the contract, an entity shall assess whether the contract is or contains a lease. A contract is or contains a lease if the contract conveys the right to control the use of an identified asset for a period of time in exchange for consideration. To assess whether a contract conveys the right to control the use of an identified asset for a period of time, an entity shall assess whether throughout the period of use the customer has both the right to obtain substantially all of the economic benefits from the use of the identified asset and the right to direct the use of the identified asset. An asset is typically identified by being explicitly specified in a contract. However, an asset can also be identified by being implicitly specified at the time that the asset is made available for use by the customer. Even if an asset is specified, the customer does not have the right to use the identified asset if the supplier has substantive right to substitute the asset throughout the period of the use. A supplier's right to substitute an asset is substantive only if both the conditions are met. The supplier has practical ability to substitute alternative assets throughout the period of the use. For example, the customer cannot prevent the supplier from substituting the asset, and alternative assets are readily available to the supplier or could be sourced by the supplier within a reasonable period of time, and the supplier would be economically from the exercise of its right to substitute the assets. That is, the economic benefits associated with substituting is expected to exceed the cost of substituting. So in the first scenario, the answer is as per paragraph B13 of IND AS 116, last mile is, which is a dedicated cable, is an identified asset since it is physically distinct. There are no substantive substitution right with entity Y, as it does not have any practical ability to substitute the alternative asset throughout the period of use. Thus, this arrangement is within the scope of IND AS 116. In the next, the alternative scenario, if Y has the practical ability to replace the lines, it would benefit from such replacement. Then entity Y has substantive substitution right. In such case, the arrangement will not be within the scope of IND AS 116. So, whether you have substitution right or not have, that is the bone of contention here. A simple example for that is, let's say you have a simple agreement where, let's say, in your organization there is some guest coming from overseas and you book for that guest a car for 1 week, right? So a nice car from a vendor for 1 week. Now, whether that is a lease agreement, right? So whether you have determined the exact nature of the car, that is the number plate, etc., और you have said that बॉस मेरे को एवरी डे ये एक होंडा सिटी या वट एवर द कार उस किस्म का गाड़ी चाहिए इस बंदे के लिए. सो if it's specified, specifically identified, and there is a substantive substitution right, so vendor can replace. So ek din, let's say he doesn't have that specific car, he can also replace it from, you know, his fleet, some other car of the similar make. So in that case, that will not be a lease agreement, that will be a service agreement. So again, whether an arrangement is a lease or not a lease sometimes is very important, and because of this ROU accounting in lease liability accounting, the way it will pan out from an accounting point of view will be very different, and therefore the scope evaluation is a very important aspect in especially arrangements where you have purchase, you know, power purchase agreements or any long-term contracts. It is very important for that. Entity X, a lessee, manufactures phone handsets. X enters into a 10-year lease contract with entity Y, that is the lessor, of a non-specified machine to be used in manufacturing parts for phone A1. It expects this model of phone to remain popular with the customers until it completes development and testing of an upgraded model, phone A2, which is expected to be launched in the near future, that is within 1 year. The current machine can be easily replaced, and the cost to install it in X's manufacturing facility is not significant. X and Y each have the right to terminate the lease without a penalty on each anniversary of the lease commencement date. The lease agreement does not provide for any purchase option in respect of the leased asset with to entity X. Whether the recognition exemption for the short-term leases is applicable to X. Is it a short-term lease or a 10-year lease? That's the question. Why is it a short-term? Both of them have an option. And there's another part to the question also. Would the answer be different if the development and testing of the upgraded model is expected to be completed in 3 years rather than 1 year? So in that case, would the answer be again no, or will it be different? In the second scenario, will it still be a short-term lease or a short-term still? Even if you are expecting 3 years to be. Still be a lease or a short term. So question is, Percy, whether it's a short term lease or a 116 lease. So there is a reasonable probability that it will be extended beyond 1 year. Okay. So Percy says that this will be a 3-yearly or a long term 116 lease. Yeah. Okay. In the second scenario. Okay, let's look at the answer. What is a lease term? Non-cancelable period for which the lessee has the right to use an asset together with both the periods covered by an option to extend the lease if the lessee is reasonably certain to exercise that option, and periods covered by an option to terminate the lease if the lessee is reasonably certain not to exercise that option. Short-term leases are defined as a lease that at the commencement date has a lease term of 12 months or less. A lease that contains a purchase option is not a short-term lease. And then there is B34, which says that in determining the lease term and assessing the length of the non-cancelable period of a lease, an entity shall apply the definition of a contract and determine the period for which the contract is enforceable. A lease is no longer enforceable when the lessee and the lessor each has the right to terminate the lease without permission from the other party with no more than an insignificant penalty. In view of the above, although the contract in the given case is for 10 years, the non-cancelable period is 1 year because X and Y both have termination rights, so you all were right, without a penalty, and the cost to replace and install the machine in X's manufacturing facility is not significant. As a result, the lease term is 1 year and the lease qualifies for short-term lease exemption, meaning that you don't have to set up a ROU asset and a lease liability. Even if the development and testing of the upgraded model is expected to be completed in 3 years rather than 1 year, the non-cancelable period is still 1 year since X and Y have a right to terminate the arrangement without penalty, and the machine can be easily replaced by entity X without incurring any significant cost. Hence, even in such a case, the lease qualifies as a short-term lease exemption. Yes, please. So short-term 12 months is sacrosanct, but let's say how the lease agreement is drafted, that is important. So, so if the lock-in period is, let's say, 12 months, and if you have to inform the lessor at least 3 months in advance, which means that perhaps at the end of 9 months you can give a termination notice that after the first anniversary I will terminate. So in that case it may still qualify for a short-term lease. However, if the agreement is such that it is minimum 1 year locking, 12 months locking, subsequent to which, okay, there is a notice period which you can give and minimum of 3 months, then it becomes 15 months and therefore it will not be a short-term lease. So it depends on what exactly are the terms and conditions of the lease, of the lock-in and the lease period. So that is again very important. But 12 months is hard-coded. There is no, it's not like a current, non-current assessment, it's hard-coded in the standard. Somebody else, yeah. Then in that case it will be a long-term lease, because again it can be very subjective, it can be very judgmental, but if it's not a very difficult thing and even cost-wise it's not very high, then in that case you can still establish that it's a short-term lease. But if there are practical challenges, and that is where again this aspects like not significant, reasonable, etc. need a fair bit of judgment in this. And again, as an auditor, what to look at, how to determine that materiality, etc. can be a challenge. That is where your disclosures, your auditing standards requirement around significant estimates and judgments come into picture. you may have to inform it to the audit committee or those charged with governance to say, okay, this is where it is, especially if the value is significant. Let's go to the next one. As per paragraph 8 of IND AS 116, the election of exemption for short-term application, the election of short-term leases shall be made by class of underlying assets to which the right to use relates. Whether classes of underlying assets for the purpose of IND AS 116 would be similar to those of IND AS 16 or 38 as applicable. So here the question is that this is not a policy choice. It has to be consistent across the class of underlying asset, right? So and class of assets is defined in IND AS 16 or IND AS 38, fixed asset or intangible assets. And IND AS 116 doesn't have any literature for what is class of assets. So the question is whether you fall back on those standards to determine what is class of asset, or there is some, judgment that you can take. The answer is that in paragraph 8 of IND AS 116, it states that a class of underlying asset is a grouping of underlying assets with similar nature and use of entities operation. And then all these classes in paragraph 37 of IND AS 16, there are all these classes and examples of separate classes of assets. It is noted that all the three standards, that is 116, 38 and 16, define a class of assets as a grouping of assets of a similar nature and use in an entity's operations. Accordingly, it would be appropriate to classify the right of use assets along with the lines of IND AS 16 and 38 as applicable, as appropriate. However, it may be noted that the above are only examples of classes of assets, and as per Schedule 3, entities may have different classes subject to criteria of similar nature and use of and the users met. So basically, in classes, class of assets have to be understood in terms of IND AS 16 and IND AS 38. X, a CNG provider to the customers, enters into an arrangement with Y, a gas storage facility provider, and obtains the right to store the gas in a specified gas storage reservoir that has no distinct compartments. At the inception of the contract, entity X has storage rights that permit it to use up to 55% of the capacity of the gas storage reservoir throughout the term of the contract. Entity Y can use the remaining 45% capacity of the storage reservoir as it considers appropriate, that is by allowing other parties to store the gas. So basically this scenario, you have a large, so you can imagine a large gas storage tank where one of the customers has a right to occupy its goods for 55% of the capacity. The remaining 45 can be given by the vendor or the owner of the storage facility to other customers. Question is this 55% arrangement with entity X, is it a lease agreement under IND AS 116? Is there an identified asset, and whether there is a substantial right to use that particular asset? Okay, so there's one answer for it is not identifiable, and I think you're saying it's not a lease contract, right? Okay. Anybody else? Okay. An asset is typically identified by being explicitly specified in a contract. However, an asset can also be identified by being implicitly specified at the time of that the asset is made available for use by the customer. A capacity portion of an asset is identified asset if it is physically distinct. For example, a floor of a building, a capacity of other portion of assets that is physically not distinct. For example, a capacity portion of a fiber optic cable is not identified asset unless it represents a substantially all the capacity of the asset and thereby provides the customer with a right to obtain substantially all the economic benefits from the use of the asset. In the given case, X only has a right to use up to 55% of the storage of the reservoir's capacity. The capacity portion used by X is neither physically distinct from the remainder of the reservoir, nor does it represent substantially all of the reservoir's capacity. Thus, in the given case, the capacity portion of X does not meet the criteria for being an identified asset, and therefore it's not within the scope of 116. Right? So again, sometimes, yeah, you have any questions? Okay. Sometimes we come across scenarios, let's say in WeWork or office kind of a scenario, co-working space. The agreement says that, you can occupy any of these cubicles. I have, a floor where there are around, let's say, 50 cubicles. And as a company, I have given you 10 cubicles. So on a first come first serve basis. So every day if your employees if you all turn up early in the morning, you will get these 10, but it's not earmarked for you, right? So it's any 10 cubicles. It can be anybody tomorrow. So this is more like a service agreement. It's not a lease agreement. It would be lease if you have reserved or earmarked a specified corner, a specified row within that, office area, stating that these are earmarked for so and so limited and for a period of so and so years, and this will be used by you. So in that case, it takes the color of a lease. Otherwise, if it's a capacity arrangement, it is not within the scope of IND AS 116. Yes, please. Both. Yes. Yes. The unit of accounting in 116 is the right. So then in that case, in one agreement, there are two things. One thing is the right to occupy the first floor, the one where you have entire occupation, right? And the same agreement also gives you an add-on right to occupy any 20 cubicles or seats in any of the floors. So again, that part of it would be a kind of a service agreement, not within the purview of this standard. That would be more of a variable consideration. But that would be service. Yeah, that will not be a lease. So the unit of contract is a right. The right this agreement conveys, is that of occupying the first floor premises for a particular period of time. The rest of it is like a service agreement. But if it's not mentioned in the contract, the first floor is for ICI. But operationally they have done that the access is. So that is where this says, I understood what you're saying. So that is why it says that you also need to look at from the vendor's perspective or the lessor's perspective, what is that facility or what is that asset like. So for example, अगर उसके पास उतना ही है, तो you cannot, under the garb of a capacity transaction, you cannot escape lease accounting. You also need to think through what is the vendor's facility like, alternative like. So for example, many a times these data center agreements, right? These days again, it has become very common. Now, data center is from a company or a bank's perspective, a very important asset. And the security, the exclusivity of that is of prime importance. So even if there is a capacity kind of a terminology in the agreement, but because the importance, the criticality of the data center to the customer, it is such that it would have right to protect it from all the exclusivity. So then in that case it takes the nature of a lease. So exactly. And also you will not, so even if 55% of the thing you have booked, but baki ka you may not allow the vendor to make it accessible to other customers because of the criticality. So you would have to then say that this is a lease agreement. Yes, yes. Which is why you will need to look into exactly, you will need to have an understanding of the asset. Whether it's a case of, let's say in this case, a storage reservoir, or whether it's a data center or a office in your earlier example. So you need to have a good understanding ke hai kya wo cheez. What? If it's based on use basis, then it's not a lease. There has to be a minimum lease payment. If it's a pay as you go kind of a basis, it's not a, yes, it's not a lease agreement. Yeah. Entity X PNG provider enters into an arrangement for 15 years with entity X or entity Y for using 60% of the capacity of a gas pipeline. The quantity of gas which is to be sent in the pipeline is decided by entity X. Entity Y makes all decisions regarding the operations and maintenance of the pipeline. Entity Y pays a fixed capacity charge per month and variable amount which depends on the quantity of gas transported. Entity Y may allow third parties to use the remaining 40% only if entity X refuses to utilize the same, that is X has a right of first, so there is a ROFR in this case, right, that the lessee has. Okay, I can prevent the lessor from giving the remaining capacity to others. It's just a ROFR, it's not a prohibition. So in this case, what do you think? Whether there will be a identified asset and therefore will it be within the scope of 116? Identified asset? He may have, but he will have to take a NOC from the, yes. Okay. An asset is typically identified as being explicitly specified in the contract. However, an asset can also be implicitly specified at that time and the asset is made available for use by the customer. A capacity portion of an asset is an identified asset if it is physically distinct, for example, a floor of a building, a capacity or other portion of an asset that is not physically distinct. For example, a capacity portion of a fiber optic cable is not identified asset unless it represents substantially all of the capacity of the asset and thereby provides the customers with a right to obtain substantially all of the economic benefits from use of the asset. In accordance to the above paragraph, if capacity portion of an identified asset which is not physically distinct represents substantially all of the capacity, then it meets the criteria of identified asset. Whether the right of first refusal over capacity be considered when evaluating substantially all criteria depends on the facts of a particular case. In the given case, X uses 60% of the capacity and has a right of first refusal for all the remaining 40% capacity. Therefore, the pipeline meets the condition of being an identified asset unless the right of first refusal is of non is not substantive. Example, if there are certain conditions due to which there is no realistic possibility that X would purchase the additional capacity. For example, X is required to pay exorbitant amount to use the additional 40% capacity. So there is a kind of a judgmental area that in this case the answer says that X uses the capacity and has ROFR over the remaining 40%. It meets the condition unless the ROFR is not substantive, which means that if certain conditions due to which there is no realistic possibility of X would purchase the additional capacity, in that case only it would not be an identified asset. So again, from the scenario of this dark fiber, light fiber scenario, where there is this dedicated cables from oceans, and then again there is many a times these telecom providers, they have a exclusivity to it, or if they don't, because of cost sharing, they have a ROFR over it. So again, this is a very important aspect, that whether it's a capacity transaction or whether it's a it's physically distinct, and again a very difficult aspect. Yes, Percy. Yeah. Yeah, sure. Yeah. Forty is to 60. Yeah, so a good point, but see now commercially, if you are not taking from me more than 50% of the capacity, at least 50% capacity, as a vendor, why would I give you a ROFR? So वो भी एक सोचने वाली चीज़ रहेगी. And so like your question is कि 40% if I have taken capacity, remaining 60% I have a ROFR. But one thing is, you will have to understand the commercial substance. Why is it that you are giving a ROFR to a customer who's only taking 40%? So if it is more than 50% or 60% or even more than that, if it's 80%, then it's a very, then I think then there's a good case of it to be an identified asset. 60%, again, that's why the answer is that, it's facts and circumstances. But if it's 40-60 per se, then a ROFR would not be such a big thing, right? Because you are not even taking half the capacity. For whatever reason, for whatever consideration, the vendor, the lessor has given you a ROFR for the remaining 60. अभी उसने वो क्यों दिया है, वो भी एक as समझना पड़ेगा in that scenario. Typically, if you are not taking substantial capacity, you would not give that customer a ROFR. Yes, please. Yes, please. Okay. 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 Okay, but the arrangement, sorry, the arrangement is with each of these individual three players, HPCL separately, BPCL. Okay. Right. 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 No, in that case, again, from whatever I understood from you, sir, it's not an agreement for a dedicated storage capacity within the overall storage pit. So there are three, so to say, users of that. Yeah. Right. Yeah. It is not, and therefore not a lease. Yeah. True. True. No. So again, it is not. So in this case, it's not exactly prescribing that it's a lease. It says that if it's 60% and for the remaining 40%, then you will have to evaluate what is how substantive is that ROFR. So then, for example, you will have to see historical trend where whether this customer Y has in fact, customer entity X has in fact given me a ROFR. Okay, so whether that ROFR is something which is a hindrance for the. So in your example, generally that, what I understood is there will be no identified asset, because there is no specific part of the storage pit that is. Acha. It can be if it is preventing the substantive substitution right of the vendor, for which you will have to evaluate historical trend, business aspects, etc. It is subjective. That's right. That's right. Uh, so, so, yeah, yeah, yeah. So again, at the cost of repetition, see, if I have a facility, one customer, which is kind of a major customer, is taking 60% of the capacity of that facility. For the remaining, he has an additional right of 40%. Now, whether that ROFR for the remaining 40% is something which he has prevented me as a vendor from giving it to other players, that is the question that one needs to address. If he has, then it's really a substantive thing, right? So, and therefore he has a right to prevent me from my substitution, rights. And therefore, in that case, it's as good as the entire facility he has dedicated for itself, and therefore it takes the color of a lease. Whereas if in a different alternative scenario, if the case is such that he has never objected, so he has never prevented me from giving the facility to others, then he is not really interested in 40. He has just kept that ROFR for whatever it is, and therefore that doesn't undermine the substitution right of the vendor, and therefore it is not a lease in that case. So therefore a ROFR, it's not totally ignored, it's not totally conclusive, but one has to think around it. In your case, looks like there are three players, and it may be in the common interest that there is three players. So it of course one will have to go through the agreement, but it on face of it doesn't look like a lease agreement to me. In case of logistics, entity X enters into a contract for a period of 10 years with a logistics company, entity Y, for the use of the latest trucks. As per the contract's terms, entity Y has a large pool of similar trucks, any one or more of which can be used to fulfill the requirements of the contract. Entity Y provides trucks and drivers as a part of the contract. The question is it a lease arrangement for trucks or is it a service agreement? Okay. So that's right. So it is not a lease because there is no exclusivity or explicitly identified trucks, and the vendor has a large fleet of assets, right? Trucks, similar trucks. But अगर उसके पास इतने ही होते, let's say he's a small vendor, he only has 5 trucks and all 5 I have done with the same terms, then one will have to, because fact pattern gives he has a large fleet of trucks. So again the company and therefore the auditor will also have to evaluate कि vendor क्या चीज़ है, right? So whether he has a large fleet of assets or trucks, or whether he's a kind of a structured entity or a special purpose entity which is actually enabler for this agreement. Entity X customer enters into a contract with entity Y supplier for a period of 10 years for a right to use a vehicle. The vehicle is explicitly specified in the contract. This is the fact. Whether entity X has substitution rights in each of the following scenario. Entity Y, that is the supplier, has no substitution rights for the first 4 years from the commencement of the contract. However, after 4 years, entity Y can substitute the vehicle at any time. Okay, that's the first scenario. So first 4 years, there is no substitution right. There is an identifiability of the asset. Okay, there is a 4-year kind of no substitution right. After 4 years, it can be, so it's a 10-year contract. And the second scenario is entity Y, that is the vendor, has a right to substitute the vehicle only on the occurrence of a particular event. In case of a car breakdown. So it's like a warranty obligation, right? If there's a breakdown, then you have to replace it. क्या लगता है? First 4 years, if there's a breakup of substitution rights, then what happens? Sorry? 4 years, okay. Okay. So entity Y has a right to substitute the assets after 4 years of the commencement. The substitution right is not substantive because Y does not have the practical ability to substitute the asset throughout the period. So the answer is that it's not lease term of 4 years because throughout the year you don't have a substitution right, then it is not having the substitution right for the entire tenure of the lease agreement. In the second scenario, Y has the right to substitute the asset only in case of a breakdown. There is no substantive substitution right because Y does not have the practical ability to substitute the alternative assets throughout the period of lease. So in that case, it becomes a lease. The warranty risk, again, there is the standard specifically says that if you are substituting it only to as a replacement, it's like a warranty replacement, then that's not to be considered. It's more like a warranty obligation, exactly. I'm sorry, please speak up. Again, there are various, different types of agreements that at least I see in practice. And again, from a tax perspective, the way it's structured is very different. So typically, yes, at least going by the requirements of identifiability, etc., they would generally fall in the lease category, in the substitution right, etc. But again, many of the companies I see, they structure it in such a way that lease accounting is not called for. Okay. Exclusive right. A club enters into an arrangement to have an exclusive right to use a specific auditorium every Saturday and Sunday for a 5-year period to screen movies for its members. During the rest of the week, the owner of the auditorium can use it for any other purpose. Is it a lease or is it not a lease? Is the standards requirement to have the lease term for a continuous period, or can I, block a particular asset for certain days, not, on a continuous calendar basis? I'm sorry? Okay. Okay. What about the control of the lessee? Exclusive right is there, but the no, it's like a facility like this. Alright, so how we are using. Okay. A contract or a part of the contract that conveys the right to use an asset, that is the underlying asset, for a period of time in exchange of consideration. What is the lease term? The non-cancelable period for which a lessee has the right to use an underlying asset together with both. So, in accordance with the above definition, an arrangement to use an identified asset would meet the definition of a lease if it conveys the right to use of an asset for a non-cancelable period of time. There is no requirement in the standard for the non-cancelable period to be continuous. Accordingly, an arrangement that provides a right to control the use of an identified asset would meet the definition of a lease, even if it contains intermittent